presented by the Bombay Stock Exchange, IPL.
Welcome back. You're with us here on Countdown. Okay, Atul Singh, Head of Wealth Management, Merrill Lynch, India is joining us now to talk about one of their reports. Atul, thanks so much for being with us. India has reached the number 12 position in HNI growth. What's the overall wealth creation looking like, and how do you see it going forward?
Well, in this particular report, we have only looked at, as far as the wealth is concerned, we have only looked at a global level. So we have not gone and done a deep dive into specific countries. So there is a wealth distribution across regions. So we look at the total wealth that is contributed, etc. But we have not gone down to individual country levels, which we do subsequently releasing this report. So in time frame of or around September, we actually publish a report on Asia Pacific, where we actually look at each of the countries in Asia Pacific in detail and look at the wealth as well as their high net worth individuals, how they have grown and how they are performing. So not in this report, but I would not be surprised if the total size of the wealth would actually be fairly correlated with the number of wealthy individuals as well. So we feel quite good about the fact that India has broken into the top 12 as far as the highest number of high net worth individuals are concerned. And our suspicion is that in terms of total wealth, it would be somewhat similar.
Right. You're talking about India and China as well, Atul. They've been driving growth. How do you see that going forward as well? Do you see them sustaining that momentum?
As we briefly spoke, that the fundamental drivers for wealth creation, the two biggest drivers are GDP growth, which drives business activities, business expansion, and hence the wealth creation process, and market capitalization growth. Now, so depending on the performance on those two aspects, the ultimate resultant of in terms of number of high net worth individuals will pan out. Now, if you think about China and India, both these countries have had and are expected to have quite significant economic growth or GDP growth, which will continue to lead to significant wealth creation process. Now, if you just think about 2011-12, so more in the near term, because of market capitalization growth, which may not be that significant, the growth for the next year could be somewhat moderated for India and China. But on one aspect, which is the GDP growth, I think both of the countries continue to do extremely well, much better than the rest of the world.
Right, fewer people in Asia Pacific have invested in equities as compared to real estate. How do you see the allocation working out in India?
Well, as I mentioned, we don't have specific data on asset allocation for each of the countries yet, which we will have in the Asia Pacific version of the report in September. But if I really think about Asia in general, and again looking at the regions in general, North America has the highest equity allocation in clients' portfolios. So over 40% of the portfolios get invested in equities, and that goes to that's contributed by the comfort that the high net worth individuals have with the capital markets, the deepest capital markets, the longest in existence, etc. Japan, on the other hand, is one of the most sort of conservative investors, where a large part of assets actually go in cash and deposits, and Asia Pacific ex-Japan is somewhere in between. The key factor standing out in the asset allocation being real estate allocation, which is actually one of the highest across all of the geographies, 31% in real estate.
Atul, so let me ask you this general question. There's been plenty of volatility. It's not been the best of years actually across the equity market for sure. What are your clients doing in terms of asset allocation?
See, you're referring to Indian markets only, right? Yes. So in Indian markets, yes. I mean, I agree with you that there were various headwinds for investors, or for that matter around the world. Now, if I really look at the key trend over the last 4 or 5 months in this year, debt has been an sort of outstanding asset class to be in, and interest rates have been going up, so clients have been looking to lock in their money even at a short end of the yield curve at a fairly high and rich rate. So from a tactical perspective, yes, some of the money has gone in debt, definitely in the first 5 to 6 months. But as far as equity markets are concerned, I think investors are definitely cautious. Not many are expecting it to be a runaway market, and not many people want to chase it. But there is clear sense of two things. One is maintaining the asset allocation, being very disciplined about the asset allocation they set forth in the beginning of their investment process. Of course, making slight changes along the way, but broadly sort of sticking to that. And the second is being opportunistic in picking up where the value emerges. So while they are cautious on the short-term outlook of the equity markets for sure, but from a longer-term perspective, they are looking to and are keen to get invested in the right companies with the right investment thesis, and most importantly, the right valuation.
All right, Atul, thanks so much for joining us and taking us through the details of that report. With that, let's head in for a very, very quick break here on Countdown. We've got about 15 minutes left to go for closing. We'll be back in a moment.
Countdown, presented by the Bombay Stock Exchange, IPF.